I want to start with you and get your sense here of the jobs data that we got this morning and whether you start to see, I guess, a little bit more, something more encouraging about the pace of economic growth here in the United States.
Yeah, look, this was clear upside for the jobs numbers this morning. I think positive on many fronts. One, not only are we seeing the unemployment rate fall now to 3.8%, so probably the tightest labor market we've seen through this cycle. We're also seeing labor participation start to tick up. So workers are coming back to the workforce. What was encouraging to us is that we saw a lot of those low wage jobs really pick up, which means that some of those supply chain issues that we've been talking about, a lot of that supply chain disruption is because we cannot get workers to enact that last mile. You order from Amazon, you need a trucker or a driver to deliver it to you. We're starting to finally see some of those workers come back to the workplace, perhaps as that Omicron variant is fading, but also perhaps as some of the stimulus checks start to wane as well. Also keep in mind the big one, wage growth, which is a signal of inflation. We were up 5.1% year on year, still quite strong in terms of wage growth, but well below expectations of 5.8%. So, to us, that's also a little bit of a sigh of relief for the Fed, who's been watching inflation numbers like hawks. Perhaps they can breathe a little bit easier knowing that they can start with that 25 basis point rate hike as well. So overall, I'd say generally good on all fronts and kind of underscores that health of the consumer, as we noted earlier in the segment.
So, Joachim, on that front, though, I mean, we're going to get another CPI report next week here, even with some of the maybe potential moderation that we're seeing in some of the data here. Do you think that the Fed's decision, or at least what they've communicated so far with regards to raising rates at least by 25 basis points and obviously ending quantitative easing, do you think that that's still appropriate given what we know so far?
Yeah, I think the Fed is really focused on inflation for now. I think the jobs report that we had gives further ammunition for the beginning of the rate hike cycle. Job growth was very strong, as discussed. And yes, wage growth was a little bit more moderate than expected. So there was a little bit of Goldilocks in the report, but it was still 5.1%. Also, the CPI numbers that we get next week are likely to show a further increase in headline inflation, given what energy prices have done and food prices have done, and also a further uptick in core inflation. So I think the Fed is really determined to go. This is what Jay Powell told us again in the testimony this week. The Fed's reaction function can really be described by three things: inflation, inflation, and inflation. That's what they're focused on. So I think they are preparing a series of rate hikes. And then maybe even more importantly for markets, the beginning of the balance sheet runoff from about the middle of this year.
Do you think, with regards to the rate hikes, though, do you think that they need to be as aggressive as the market seems to think they will be, 6 or 7 hikes this year? Do you think the Fed can be gradual?
I think 6 to 7 hikes, which is what most people in the market see, is a little bit aggressive to us. I think 4 or 5 rate hikes this year is quite realistic. I think they want to get in a series in the next several meetings. So the next 3 to 4 meetings, you'll probably see 25 basis points each, unless something happens on the way. But overall, I think given that the balance sheet rundown will be another focus by the Fed, I think they will then slow the pace of tightening on rates during the second half as they begin a fairly fast balance sheet runoff. And then the other thing we should remember is that as the Fed starts tightening, usually bad stuff starts to happen. You never know where exactly, but the risk of a financial accident is rising, particularly with the balance sheet runoff.
Mona, I want to give you the last word. We only have about 45 seconds here. I am curious as how you think the market will react to this, if that is indeed what the Fed does.
Yeah, generally I think the market is ready now for a 25 basis point rate hike. I think they'll be curious to see what the economic projections are from the Fed, especially around inflation. Clearly, the risks are now for higher inflation, at least headline inflation, over the next few months. The question really is, as we get towards the back half of the year, do we see inflation moderating? And, of course, we get base effects that are rising. Year-on-year comps get tougher. We may start to see oil prices finally start rolling over the other way. And so, Joachim's point of 4 to 5 rate hikes, I think the next 4 to 5 meetings are live, and then we pause, see where we are, and perhaps if inflation is in better shape, we get a more gradual pace going forward.